$8.5 million gone. A NASCAR champion, a borrower lawsuit, and headlines screaming that an index universal life policy imploded. You've got people online saying, you see, IUL is a scam. Permanent life insurance is trash value. Cash value is trash value. Buy term and invest the difference. Case closed. But here's a controversial truth that nobody wants to say, because this isn't clickbait. This wasn't an index universal life failure. This was a strategy mismatch. This was a design disaster. And this is a compliance nightmare. And if you're a middle-class family watching this, or an agent trying to do the right thing, you cannot afford to get this story wrong. I'll break it down in this episode, starting 3, 2, 1, let's go.
Who are we? Hey, 7-figure squad. What we go? Run it up, run it up.
Full disclaimer, I'm a licensed life insurance agent. I'm not a financial advisor. I'm not an attorney. I've been in the life insurance space for over 2 decades. I've seen good strategies change families' lives with life insurance and annuities, and I've seen how bad strategies blow people up. Over the last few weeks, my DMs, texts, emails, our agents, our clients, even haters. Matt, please react to the Kyle Busch lawsuit. Matt, is IUL dead? Matt, are middle-class families about to get wrecked with index universal life? So unlike most of the internet, I didn't just react to headlines. I actually took time to actually read the 50-page complaint. Again, I'm not an attorney, but I studied the timeline, I studied the ownership, I studied the structure, and I studied the allegations against the agent and the life insurance carrier. Now, this video is not defending a company. This video is definitely not attacking a couple. This video is about one thing: clarity. Because clarity protects families and fear does not. Here's a big headline. The lawsuit claims that Kyle and Samantha Busch paid over $10.4 million in premiums into a series of index universal life policies and allegedly suffered a net loss of about $8.58 million. Now, that's what they're alleging. This is not a final judgment. This is not a court ruling. And this is not the full story. However, let's walk through what actually went on structurally from what we know based on documents, because that's where the truth is. Now, the first major point almost nobody on social media is talking about, that these policies were not personally owned. They were owned by irrevocable life insurance trusts, commonly known in the insurance industry as ILITs. Now, ILITs are not some shady tool. ILITs are a classic estate planning structure. In fact, we sold a $23 million life insurance policy to a wealthy family in our San Francisco office to make sure that the estate taxes are paid through the irrevocable life insurance trust. You see, wealthy families have used ILITs for over a century to keep life insurance out of their taxable estate, to make sure that their assets are protected from creditors and they can pass on generational wealth to kids and the grandkids in a controlled way. But here's the part that changes everything. ILITs are not designed to be your personal retirement income supplement using a life insurance policy. By design and by tax law, once a policy is placed in an ILIT, where the owner and the beneficiary is an irrevocable life insurance trust, the insured, the Kyle and Samantha Busch, are no longer maintaining ownership over it, which means they don't control it. And they cannot simply borrow money from it from a personal manner. And they can't borrow from it without potentially blowing up the estate planning and tax treatment of an irrevocable life insurance trust. So let me say the question out loud that a lot of us in the life insurance industry are asking. Wasn't this designed to be owned by an irrevocable life insurance trust? Yet it was sold as a retirement income strategy? See, those two things don't go together. ILIT means legacy and estate planning. You don't touch it while you're alive. That's why it's called irrevocable. Retirement income equals personal access and control, which many people commonly have ownership of index universal life policy through their personal name and social security number. Now, as an agent, you can't sell an ILIT owned policy as if we're a personal cash flow machine for them. So already we're looking at a fundamental mismatch between ownership, structure, and promised outcome. Now, that's not an indictment of IUL as a product at all. This is a red flag in how the strategy was presented and structured. Now, I'm gonna go over some of the core allegations in the complaint, and I've highlighted them myself personally, but according to the lawsuit, the clients were told things like this policy would be fully funded after a few years, that it would be then self-sustaining, that included some sort of guaranteed multiplier, and it could provide tax-free retirement income for life. Now, if that's accurate, these exact phrases are now how compliant agents are trained to describe and using life insurance to supplement one's retirement. On top of that, the complaint alleges that the use of placeholder illustrations that weren't final and yet were used in a sales process, that aggressive assumptions were used in these illustrations by crediting rates and loans, and then having a high initial death benefit structure that drove up internal cost, policy fees, and expenses and charges within inside the policies, which often coincides with higher agent commissions. Plus, here's a part that got me confused. Emails from the carrier staff that, at least as alleged, blurred the line between a life insurance carrier or wholesaler vice president becoming a neutral carrier to now acting like a life insurance agent or quasi-financial advisor. Now, add to that, the complaint says that the writing agent had prior disciplinary issues with the State Department of Insurance. Basically, he didn't disclose something in his background. I believe the felony was he had carried marijuana before it was legal. So what does this sound like? It sounds less like IUL inherently doesn't work and more like an example of misrepresentation, design choices, and supervision issues. Again, that's not me saying they're guilty. That's me saying if the allegations are true, this is about how the tool was used, not that the tool itself, the Index Universal Life policy, is garbage. Now, before I move on, there's another detail in the lawsuit that deserves real attention. And anyone who owns a permanent life insurance policy, an IUL or sells IUL, you need to hear this. The complaint states that these policies went through a 1035 exchange, meaning that the original life insurance policy was replaced with a new one just 2 years after the original one was issued. Now, let me explain why that's a big deal. See, in the early years of any life insurance contract, I don't care if it's a whole life policy, an index universal life policy, even a variable universal life policy, a year universal life policy, you'll have what's called a surrender charge period. This is standard across the insurance industries because carriers front load costs, they front load commissions and administrative setup in a permanent life insurance policy. And here's the key. Their surrender charge, that schedule, is highest in their early years and declines slowly over time. So when you replace a policy only after 2 years, you reset that surrender charge clock right back to the maximum. What this means is the client starts over at the highest surrender charge penalties. The internal charges effectively restart. The new policy has the steepest early year cost that the client eats and pays, and yet they've already paid big premiums into the original contract, which now gets swapped out. Now, let me be very clear. There are legitimate reasons to do a 1035 tax-free exchange from one policy to another. For example, if the policy is unsuitable, if the policy and product is obsolete, if the client has a new purpose, or if the new carrier offers meaningful advantages, not just 2 years into a new product though. But none of that changes the fact that replacing a policy this early requires extreme justification. It requires extreme transparency, and it requires extreme documentation. So naturally, the question anyone in the insurance industry would ask is, why would the agent, why would the client, why would the insurance company all sign off on a replacement and 1035 exchange only 2 years in? Remember, I'm not accusing anyone of doing anything wrong. I'm not speculating motive. I'm simply saying this. Early replacements and 1035 exchanges are one of the biggest suitability red flags in our industry. And regulators look at that very closely. If the allegations around the timing of the 1035 exchange are accurate, then this isn't about whether IUL works or doesn't work. This becomes a conversation about suitability, about documentation, about oversight, and aligning strategy with the purpose of the IUL to begin with. Because when you combine an ILIT ownership structure with an early 1035 exchange and a retirement income narrative that doesn't fit the chassis, you don't have an index universal life product problem. Again, you have a strategy and alignment problem. And those are the situations that lead to lawsuits. Now, here's something that every life insurance professional immediately looks for in a situation like this. The signed delivery life insurance illustration from the carrier. You see, when a life insurance policy is delivered, it is standard and often required from the life insurance company that the client sign a final compliant illustration. See, this document will spell out the premium schedule and funding years. It will spell out the policy charges and expense flows and surrender charge period, the caps and the floors of an index universal life policy, the loan assumptions. It'll describe the surrender schedule. It'll describe the long-term policy projections, both in guaranteed and non-guaranteed columns, IRS 7702 compliance language, and all the disclosures that regulators insist on that is the single most important document for evaluating whether the client saw and understood the actual design of the index universal life policy. Now, in this lawsuit, right now, that signed illustration somewhere in there, it's not attached. It's not referenced. It's not even put in as an exhibit A, B, C, or D. So as it stands today, nobody in the public, including other life insurance professionals, can actually review and validate the actual life insurance policy that was sold that the clients actually signed. They don't know what assumptions were shown. They don't know how the policy was actually funded. They don't know whether the structure truly supported a retirement income supplement type of story, or whether the design was ever suitable under IRS Code 7702. And why is that important? Because 7702 has the language for supplemental tax advantage distributions. So until that signed illustration surfaces, we're all looking at this case with one eye closed. And this one eye closed, not having the life insurance illustration, that's worth saying that out loud because we definitely need the signed life insurance illustration. Now, let me address the life insurance carrier side, which is Pacific Life. You'll only see people online saying, see, carriers are shady. Insurance companies are the problem. So let's ground this in facts. Pacific Life, I started my career in Southern California when I got out the Marine Corps. And I remember going to Newport Beach and Fashion Island, seeing the Pacific Life building. And Pacific Life was founded in 1868. Over 156 years in operation. They're rated A++ superior by AM Best, AA- by S&P and Fitch. They have over $225 billion, with a B, billion dollars in assets. And here's the important part, especially with index universal life policy purchasers and holders, that is structured under a mutual holding company model, which means that they're focused on long-term stability, that quarterly Wall Street earnings to the stockholders. But here's the part that most critics don't mention. Pacific Life, along with a small group of top-tier carriers, is a go-to company in advanced markets. And everybody in the life insurance market knows it. What type of policy are they known for structuring? Policies such as corporate-owned life insurance policies known as COLI, bank-owned life insurance policies known as BOLI, non-qualified deferred compensation, executive bonus and retention plans, split dollar, large case ILIT funding, and high net worth estate planning cases. Everybody knows in the life insurance industry that Pac Life is one of the best insurance carriers to get for those strategies. In addition to that, America's biggest banks and corporations don't routinely use life insurance carriers that quote unquote don't work. So again, this doesn't look like a weak company or a faulty chassis type of story. It screams to me, again, this is my opinion. I could be wrong. You need to take a look at the document, see for yourself. It looks like a design issue, a sales issue, and sadly, from an insurance carrier standpoint, potentially an oversight story. Now, Kyle and Samantha Busch did a video saying something to the effect of, if this could happen to us, imagine how many regular people find out what they've been duped into inside an index universal life policy. I get their emotion. Let's you and I watch this video together.
And insurance policies that are also retirement policies for planning for our future. And unfortunately, ours did not go well.
Yeah, as you'll hear when this broadcast comes out, it was a major scam. We tried to do what we thought was best for our family, for Brexton and Lennox. We were trying to be financially responsible for them and plan for our future. And little did we know that by investing money in this scam, it's all gone. And so the reason we came out here today is, as you guys know, who've followed us for a while, every time God puts a struggle in our path, we're going to try to use it for good. And so we're out here speaking out about what happened, because this just isn't happening to athletes and celebrities.
Right.
This is happening to teachers, police officers, veterans. This is happening to widows. These are people who are 70 years old. They have nothing else to fall back on. These are people who are, they've worked hard, they've made a small business, they are ready to retire, and they buy into these scams and they lose absolutely everything. And so, Kyle and I will use this platform to try to do all the good that we can. And so we're going to keep fighting Pacific Life, and we're going to show the world that this was a huge and utter scam.
That's right. So tune in for further updates as we come along further in the case.
Now, initial reaction to me just watching that. If I thought I lost $8.5 million, I'd be furious too. But emotion and accuracy aren't the same thing. What happened to them based on what simply just owning an IUL. The language I'm hearing here is, I'm doing it for our kids. We're coming after Pacific Life. Notice that the agent wasn't. So I'm thinking, is this really structured for ILIT or retirement income? Because inside the complaints talk about retirement income strategy. But yet in her words, she's like, we want to do the best for our kids. So was this for ILIT? I'm still confused. And on top of that, we're coming after Pacific Life. Now, why did he specifically say Pacific Life? Because the insurance company's got the deep pockets. not the insurance agent. The insurance company's got the deep pockets. Now, in addition to this, the language I was using, it was owning policies inside ILITs. Again, owning policies with inside ILITs are not designed for personal retirement income, which is I'm reading what it was sold for. So being sold a retirement income strategy, I'm not sure it's still matching up. Now, potentially seeing illustrations in the language that overpromise the outcomes, I still have to see more of it. So having a strategy that appears on paper to have been designed around aggressive loans, designed around high internal charges, designed around allegedly high commission incentives, this is not what happens to the vast majority of people who own properly structured, appropriately funded index universal life policy designed for their goals with full disclosure. So now I understand while their pain is absolutely real, their conclusion that this is essentially what everyone goes through, I'm sorry, that's not accurate. Now, in addition to this, they also specifically hired a law firm that specializes in litigation, specifically against insurance companies and insurance agents with IUL and all the language in accordance with this complaint. There's nothing inherently wrong with hiring this law firm. I mean, these firms are built to be aggressive. I'm pretty sure they have a life insurance agent that works with them that understands the language, that knows how to feed this couple what to say on camera. Now, they know how to also frame a case in the harshest light possible to push the life insurance carrier. Why? That's their business model. So understand, you're not reading a neutral industry white paper. You're reading a legal document that's crafted to win a lawsuit. Now, before everyone rushes in with the comments like, see, this is why you should always buy term and invest the difference, Matt. Listen, we've already unpacked that. And we frankly destroyed that argument with data. And we did a separate video on it called, Does Buying Term Insurance, Investing the Difference Really Work? Check this video out right here. Because if you want the math, if you want the behavior data, if you want the statistics, go watch this video next. And let me talk directly for a moment to the buy term and the difference crusaders, the Dave Ramsey disciples who think that this lawsuit is their big gotcha moment, okay? Now, you and I, we know the script. Cash value is trash value. Permanent insurance is just garbage. Only suckers buy IUL. Just buy term and invest the difference, right, bro? Now, sounds clean on a whiteboard, but the real world isn't a whiteboard. Again, here's the reality. Dalbar studies show that the average investor dramatically underperforms the market because of what? Emotions and behavior. Federal Reserve data shows that a huge percentage of Americans have very little savings or no retirement assets at all if they were investing the difference to begin with. We showed data that roughly 90% of term policies lapse before they ever pay out a claim. So, buy term and invest the difference? Well, this assumes a level of discipline, a level of coaching, a level of behavior that most households today just simply does not have. Now, this doesn't make people dumb. It makes them human. And using one complex, poorly designed, poorly aligned IUL case and lawsuit to declare that permanent life insurance is dead, well, that's intellectually lazy and a misaligned strategy simply that blew up that everybody now is using to their advantage. Doesn't mean all strategies are bad or all index universal life policies are bad. Now, financial tools, life insurance policies don't fail on their own. The way they're used fails. Now, some of you may have also seen a long post floating around online from a very loud opponent of index universal life celebrating this case as proof that IUL is broken. Finally, we can tell everybody that permanent insurance is the problem and the only righteous path is buying term insurance. Now, let me address our main talking points one by one without naming them because this isn't personal. Totally get it. This is purely educational. One says, explain this $8.5 million loss without saying it's bad structure. Well, the lawsuit itself cites the misrepresentation. The ILIT ownership used it as if it were a retirement plan. Placeholder illustration and commission-heavy design choices. Now, that's not an excuse. That's literally the foundation of this claim. So, number two, always buy term and invest the difference. Now, on a spreadsheet, sure. But in real life, most people, again, they don't invest the difference. And you know that. Most people don't have a consistent coach or discipline to tuck the money away. So they don't have that discipline. And most people don't keep their foot on the gas for 30 or 40 years. If that mantra actually worked on a mass scale, we wouldn't be in a retirement crisis today. The third thing is here, life insurance is only for your beneficiaries. Using it while alive defeats the purpose. Now, that's a philosophy, but it's not a fact. Millions of families and nearly every major corporation use permanent life insurance policies for both protection and long-term accumulation and tax diversification. How? It's used when it's structured and communicated correctly. You can absolutely combine death benefit, combine legacy. You can combine strategic access to the cash value if The design matches the goals. Fourth thing, term is renewable to 100 years old. The kids won't need you then. Well, guess what? Renewable doesn't mean it's exactly affordable. Most people aren't paying premiums in their 80s or 90s, especially annual renewable term in your 80s and 90s, which is crazy expensive. And life insurance isn't about just replacing income for kids. It's about estate tax issues. It's about business succession. It's about charitable planning. It's about equalizing inheritances and equitable distribution of the inheritances. It's about providing liquidity to an estate or a trust. See, that line pretends life insurance is just one job, and it isn't. In my book, Gotcha, I talk about the guy that built my website. Thank God he bought an index universal life policy with living benefits, with a lot of these detractors don't have in their offerings when it comes to their life insurance shop. But the guy that built my website, so many clients of ours had purchased policies, index universal policies with living benefits, and guess what happened? One had a stroke, one had thyroid cancer. We had people have heart attacks, and guess what they're able to get from the life insurance policies? These index universal life policies when they survived. They're able to get the portion of the death benefit while alive without paying a dime in tax or additional fees. Want proof? Watch this video right here of my client, Dustin Frampton, who built my website, and he had a stroke at 38 years old, but thank God he owned an index universal life policy. Number 5, don't get fooled by tax-free loans. These fees and costs of insurances will kill your return. Can that happen if a policy is underfunded, overborrowed, and never really reviewed? 100%. Yes, it can. Does that mean it's going to happen guaranteed in every policy that's out there? Absolutely not. Why? Banks, corporations, universities, and high net worth families, they don't commit billions of dollars of their money into these life insurance strategies that always implode. The difference between hype and stewardship is design, it's disclosure, it's management. Number 6, insurance companies aren't regulated. Are you serious? This one is simply false. Insurance is one of the most highly regulated industries in the United States. State departments of life insurance companies follow the NAIC model regulations. If you're doing business with insurance companies, they have reserve and solvency requirements. They have product filing and approvals that you have to go through before you sell policies in a particular state. They have market conduct exams. They have suitability rules. They have replacement rules. They have ongoing audits and exams. See, different from banking, yes, but unregulated? Absolutely not. Number 7, just get a loan from a bank or brokerage instead. You see, bank loans and security-backed lines of credit are very, very powerful tools, but they come with margin call risk. They come with line freezes. They come with rate changes. They come with collateral reevaluation. They come with forced liquidations at times. Now, policy loans on index universal life policy or permanent life insurance policy in general, when managed responsibly inside properly designed products, simply behave differently. Now, these tools are not interchangeable. Number 8, if this can happen to a wealthy couple, imagine what's happening to everyone else. Again, that line is emotionally persuasive, but sadly, logically wrong. See, most people don't put their policies inside an ILIT and call it a retirement plan. People don't use placeholder illustrations. Again, we don't actually have the actual signed illustration that the client agreed to. Most index universal life policies don't design overly aggressive loan strategies, and they don't have this exact combination of factors either. This is a very specific situation, not a universal life or index universal life indictment. So let me zoom out and speak more broadly to the anti-permanent insurance crowd. Detractors of IUL or any permanent life insurance policy often say things like permanent life insurance policy is a scam. Now, if that were true, somebody needs to tell these people, like Walt Disney, who used cash value to help fund Disneyland, like Ray Kroc, who used policies to keep McDonald's alive, like JCPenney, who used it to make payroll during the Great Depression, like Doris Christopher, who funded Pampered Chef with a policy loan, like Jim Harbaugh, the former coach at the University of Michigan, whose comp plan as a head coach was partially life insurance funded, called Split Dollar. What about Shaquille O'Neal, who talks about using it for generational wealth? What about Magic Johnson, who includes in his long-term planning and owns not one, but 2 life insurance companies that have permanent life insurance policies as an offering in his company? What about the Rockefeller family, whose dynasty is a textbook example of life insurance-based wealth transfer? And what about the banks and Fortune 500 companies holding hundreds of billions of dollars in permanent life insurance? You see, scams don't survive 150 plus years of regulation and get used by the most sophisticated institutions in the world. The fees are too high conversation? Well, you see, everything has a cost. But the question is, does the strategy deliver enough value to justify the cost for a given family, for a business, or for institutions? What about, Matt, loans will destroy your insurance policy? Yep, you're absolutely right. They can, if the policy is not designed, funded, or monitored correctly. The same way margin loans and margin calls can destroy brokerage accounts, or HELOC misuse can destroy a real estate portfolio. How about you only need term? You see, term is awesome for pure income replacement. It's perfect for a specific time window, but real life doesn't always fit perfectly into a 10, 20, or 30-year term look back. What's the reality? People live longer. People have health changes. People have businesses and estate needs that evolve. And term and permanent life insurance are tools in a toolbox, not rival religions. No, insurance companies aren't regulated. Well, we already addressed that. It's just factually wrong. If this can happen to one high-profile company, it must be happening to everyone. Now, that's not how math, how law, or risk management works. This case shows what happens when ownership, strategy, design, and communication are all out of alignment. Now, it's not a warning about index universal life policies. It's a warning about misalignment, not a verdict on an entire product category. Now, permanent life insurance, including index universal life policies, universal life policies, whole life policies, and other modern variations, is not some fringe, sketchy strategy. It has been part of America's financial backbone for well over a century. From Disney to McDonald's, from JCPenney to Pampered Chef, from college endowments to executive compensation plans to the Rockefellers and modern entrepreneurs, permanent life insurance has been used to build, to protect, transfer wealth over and over again. Now, it's not perfectly done in our country. It's not done without abuse, sadly. It's not done without bad act. But no serious person can look at history and say, this whole thing is a scam. So where does this all leave you? So if you're watching this as a client, or you're watching this as a family member, or you're watching this as an agent, here's my take. The Kyle Busch case is absolutely serious. Misrepresentation is serious. Oversight is serious. Ownership mismatch, again, is serious. Now, these lessons matter, but the conclusion, there it is. IUL is trash, permanent life insurance is done. That conversation, that narrative, that's lazy and that's dangerous. The truth is more nuanced. Financial tools don't fail on their own. Misalignment fails. Misrepresentation fails. Sadly, bad expectations fail. And here's a key line I want you to remember, and this is carefully worded. When a policy is aligned with the right goals, structured transparently, and monitored responsibly, it has the potential to operate as intended under the guidelines it was built on. Guarantees, no magic, no hype. How? With proper alignment, with proper structure, and proper stewardship, these things can work. So before you panic, before you cancel your policy and eat the surrender charges or swear off an entire category of tools because of one highly specified case, get clarity. Get a qualified second opinion. And make sure whatever you own matches your goals, it matches your risk tolerance, and matches your understanding. My friends, stay educated, stay protected, stay empowered, and stay subscribed to the 7 Figure Squad YouTube channel. Please put your biggest takeaways in the comment section below. And if you haven't done so yet, make sure you hit like and share this with an insurance professional or a client that you know. From Dallas, Texas, I'm your Money Smart Guy, and until we meet again, continue to live smart, continue to love smart, and be money smart today.